Welcome to The Debate. Imagine holding over, 843,000 Bitcoin in a corporate treasury. That is literally billions of dollars.
Yeah, an astronomical amount of capital.
Right. Now imagine selling just 32 of them, to fund some standard corporate housekeeping.
Which mathematically is less than a drop in the ocean.
Exactly. It is absolutely nothing. Yet, when MicroStrategy did exactly this recently, liquidating about $2.5 million worth of Bitcoin, the market just panicked. It caused this noticeable dip and sent a real shiver through a community that's been, frankly, deeply conditioned to believe you never, ever sell.
The classic hold on for dear life mentality. Yeah.
Right, the HODL mindset. So today, we are asking why that happened, and more importantly, what it means for your portfolio.
Because the central question we are debating is really this. Does this operational sale, especially when you combine it with impending macro catalysts like the Clarity Act and the November election, truly signal a structural setup for investors to dollar-cost average all the way down the risk curve?
Or does this narrative fundamentally misread how upcoming regulatory shifts will actually direct that capital?
Right.
I argue that the current macro environment creates a structurally sound runway to systematically DC across the entire risk spectrum, capturing value as liquidity naturally cascades downward.
And I take the opposing view. I argue that upcoming regulatory clarity will likely concentrate capital heavily in top-tier, compliant assets, making the rotation into speculative microcaps a dangerous misinterpretation of the market's future architecture.
Let's start with the MicroStrategy event itself, because I think people are entirely misreading the mechanics of what CEO Phong Lei is doing.
How so?
Well, this sale of 32 Bitcoin isn't a loss of conviction from Michael Saylor. It is definitive proof of market maturation. If you actually look at the SEC filings, MicroStrategy is executing a highly dynamic capital management strategy here.
Right. They use that $2.5 million to fund regular distributions, right?
Yes. Dividend payouts on their preferred stock. They are operating like a sophisticated, traditional financial engine now, not just an impenetrable vault. And crucially, this maturation of Bitcoin as an active corporate treasury asset is colliding directly with massive second half 2026 catalysts.
You're talking about the legislation.
Exactly. We are looking at the Clarity Act, which is expected to see major progress ahead of the 250th 4th of July, alongside this massive wave of deregulatory pro-crypto rhetoric characterizing the November presidential campaign. This combination creates an unprecedented institutional greenlight. It provides a robust, mathematically sound justification for a disciplined DCA strategy. Because as that institutional capital enters, it anchors in the $1.38 trillion market cap of Bitcoin, flows naturally down into liquid blue chips like Litecoin and XRP, and eventually, it seeks high beta growth in ecosystem plays like Jasmy and MK.
Okay. I hear your point on the math of the MicroStrategy sale. I will absolutely grant you that 32 Bitcoin out of 843,000 is statistically insignificant to their balance sheet.
Glad we agree on the math, at least.
Sure, but using that insignificant event paired with macroeconomic regulation to declare some sort of ultimate DCA Cue for the entire digital asset market is a massive conceptual leap.
A leap? How is following the liquidity a leap?
Because the core issue here is a deep misunderstanding of the mechanics of the Clarity Act itself. Its primary function is establishing definitive regulatory boundaries for stablecoins and digital assets. Regulatory clarity does not trigger a rising tide that lifts all boats.
Well, history would suggest...
Hold on, let me finish the thought. It creates a highly rigid filtering mechanism. Institutional capital requires compliance, safety, and auditable borders by mandate. When the Clarity Act passes, that capital will not flow freely down the risk curve into speculative tokens.
You don't think any of it trickles down?
No, it is going to be trapped in structurally clear, compliant vehicles. It will park in regulated stablecoins like TrueUSD, and it will utilize established top-tier networks like XRP. And it will stop there. It will structurally starve the ultra-high-risk microcaps.
Wow. Okay.
Advising everyday investors to DCA into meme tokens and test networks based on a thesis of macro regulatory clarity is, Frankly, a fundamentally flawed extrapolation of how institutional money actually operates.
Okay, I see why you think that. But let me give you a different perspective. You are looking strictly at the institutional endpoints and completely ignoring how market psychology is creating the entry point right now.
Psychology over structure?
Psychology informs the structure. You acknowledge the math of the MicroStrategy sale is insignificant, right? But look at the market's reaction. We saw a highly visible dip. What does that tell us?
Right, that retail is panicky.
Exactly. It tells us that retail investors are still paralyzed by headlines rather than guided by structural math. I mean, it is akin to panicking over a billionaire's financial health because they sold a fraction of a single share to buy a cup of coffee.
Right, it's irrational.
Highly irrational. And when retail investors create a sudden pullback over a highly logical SEC-filed corporate dividend payout, that irrationality is the textbook opportunity for DCA strategy.
I'm sorry, but I just don't buy that. Let me tell you why.
Go for it.
You cannot have it both ways. You are using an irrational retail overreaction to justify building positions in highly volatile speculative assets. Let's really look at that logic.
I'm looking at the discount it creates.
What you are essentially saying, retail is acting irrationally and panicking over a standard $2.5 million corporate dividend payout. Therefore, this is the perfect time to trust that retail liquidity will support my high beta ecosystem tokens. That is intellectually inconsistent.
Wait, how is capturing a discount inconsistent?
Because if retail investors, the very people driving the volume in the lower bounds of the risk curve, are so fragile that they panic sell over a rounding error on MicroStrategy's balance sheet, they are entirely unequipped to handle the systemic volatility of microcaps.
I think you're missing the point of the strategy.
Am I? You can't rely on retail fragility to create your discount at the top and then expect robust sustained retail liquidity to act as your exit liquidity at the bottom.
I'm not saying you rely on them for exit liquidity. I'm saying their fragility is exactly why staggering your DCA entries is the correct mechanical approach. It absorbs that headline-driven volatility.
By catching a falling knife?
No, you don't have to guess the absolute bottom. When retail panics, you just capture the average. But let's move off the psychology for a second and talk about the mechanics of the capital flow, because you made a fascinating point a minute ago.
About the filtering mechanism?
Yeah, you said the Clarity Act creates a filter and that capital will park in true USD or XRP and just stop. If you're an everyday investor listening to this, you've always been told that regulation is the bridge that lets Wall Street into the space. But you are essentially arguing that regulation is actually a wall, trapping them in the lobby.
That is exactly what I am arguing. A wall is the perfect metaphor, actually, and we need to understand mechanically why that is. A compliance mandate isn't a suggestion.
Right, it's a law.
Exactly. If you manage a billion-dollar hedge fund, your compliance officer literally blocks the execution of a trade if the asset doesn't have an audited U.S. domicile reserve or explicit regulatory classification.
Which true USD has.
Right. TrueUSD, or TUSD, is designed to have that. A random decentralized finance token does not. So, institutional capital acts like a high-speed bullet train. It has incredible power, but it requires highly specific, standardized track gauges to run.
Okay, I like the train analogy, but
It cannot simply drive off the end of the tracks onto a dirt road just because there is momentum. If the Clarity Act passes prior to July, regulated stablecoin issuers stand to gain immensely because TUSD transforms into a massive capital parking vehicle ahead of compliance mandates.
parking vehicle, yes, but not a permanent home.
For institutions, it might as well be. The institution secures its yield, stays within its legal risk parameters, and categorically refuses to trickle down into speculative infrastructure.
But the tracks do connect. That is exactly where XRP comes in. XRP has a $78 billion market cap, and the source material explicitly highlights it as a prime beneficiary for cross-border banking rails once definitive U.S. frameworks are established.
As a utility, yes.
Right, mechanically, cross-border settlement requires liquidity pools to function. If a bank is using XRP to move millions of dollars from the U.S. to Japan, XRP acts as a solid middle layer. It provides the necessary compliance you're talking about, but it also interfaces with the broader digital economy.
But interfacing doesn't mean funding.
Capital doesn't just sit in a vault. It seeks yield. Once institutions are comfortable on the XRP rail, the wealth effect historically dictates that some percentage of that capital pushes further out on the risk curve to find higher returns.
I don't disagree that XRP provides cross-border utility. I totally disagree with the assumption that institutional use of a utility rail naturally bleeds into speculative microcaps.
Why wouldn't it?
Because using a network for cross-border settlement is an operational expense for a bank. It is not a speculative investment vehicle meant to fuel a broader ecosystem. And this brings us to the core disconnect in this whole DCA thesis.
Which is?
The thesis assumes that because the top of the market is getting regulated and validated, the bottom of the market suddenly becomes a safe bet for staggered buying.
It's not about being a quote-unquote safe bet. It's about structural rotation. The source material provides empirical evidence that capital is already rotating into specific sectors across the risk spectrum precisely because of utility, not just speculation.
Speculative utility, maybe.
Let's look at the mechanics of the assets mentioned. We have Jasmy, a data democracy token. It is attracting significant retail and structural attention right now because Internet of Things, or IoT, data privacy laws are tightening globally.
Right, the Japanese data laws?
Exactly. When those laws tighten, corporations need verifiable ledgers to prove user consent. Jasmy's architecture monetizes that specific compliance. We have React catching rotating capital as decentralized developer frameworks mature, and further down we have MK, an ERC20 DeFi token.
Which is highly volatile.
But it recently bounced over 40% off its local support levels. Mechanically, MK operates as a smart contract on the Ethereum network. That 40% bounce is empirical proof that liquidity on the base layer is alive and actively seeking breakouts in the application layer.
Or it's just noise.
Staggering DCA entries into these tech rotation targets is a historically proven way to capture value as the broader ecosystem expands. I mean, how can you look at a 40% bounce in an ERC20 token and not see it as proof that liquidity is successfully flowing down the risk curve?
I look at a 40% bounce in an ERC20 DeFi microcap and I see exactly what it is. Short-term day trader momentum?
Just momentum?
Yes. It is a fundamental error to confuse speculative retail momentum with structural institutional adoption. A decentralized finance token bouncing off local support is an artifact of low liquidity order books, not the vanguard of a trillion-dollar institutional wave unleashed by the Clarity Act.
You're dismissing a massive percentage move.
Because context matters. If a whale buys a few $100,000 of MK, it spikes 40%. That has literally nothing to do with macroeconomic legislation in Washington. And this brings me to the most dangerous part of the narrative presented in the material.
Let me guess, the test tokens.
Yes, it explicitly pairs the Clarity Act, a landmark piece of federal regulatory legislation, with assets like TTT, an ultra-high-risk early test token on Solana's Pump.Fund platform.
Okay, but hear me out.
Conflating serious regulatory frameworks with meme coin volume trackers is a profound misreading of the macro environment.
I see why you think that's a dangerous pairing, but let me give you a different perspective on how portfolio spectrums actually work. You are looking at TTT as if the material is suggesting institutions are directly buying a test token on Pump.Fund.
They absolutely are not.
They aren't. But TTT serves as a high beta proxy for base layer volume. Mechanically, when institutional money enters the Solana base layer, Solana's price appreciates.
Okay.
The people who already hold Solana suddenly experience a wealth effect. Their portfolios are up. Historically, those native users take their newfound base layer wealth and deploy it into higher risk native assets, like meme coins, seeking exponential returns.
So you're banking on trickle-down gambling.
It's behavioral mechanics. TTT is essentially a volume tracker for that behavioral mechanic. You don't allocate the same weight to it as you do to the $1.38 trillion anchor of Bitcoin. But as part of a staggered DCA strategy, it mathematically captures the extreme end of the wealth effect.
You are asking a listener to look at Michael Saylor executing a logical corporate dividend strategy, to look at the U.S. government establishing serious legal boundaries for stablecoins, and to conclude that this means they should DCA into a test token on a platform called pump.fun because of a secondary wealth effect.
When you frame it like that, it sounds extreme, but
I'm sorry, but I just don't buy that. The structural setup for the top of the market is incredibly strong. Bitcoin as a benchmark is undeniable. Regulated stablecoins will be immense.
so we agree on the top.
We do. But advising a strategy that assumes the rising tide of federal regulation will inherently lift the boat of an ultra-high-risk speculative test token is entirely disconnected from how capital preservation works at the institutional level. The systemic risk is mitigated at the top for the assets at the top. That is the critical distinction.
But that mitigation changes the entire calculus for the space. Think about how traditional finance works. You have your large-cap anchors, your mid-cap utilities, and your small-cap growth plays.
Sure.
For years, digital assets were treated as one monolithic, highly speculative blob. The maturation we are seeing, MicroStrategy treating Bitcoin as a fluid corporate asset to pay dividends, the government establishing compliance frameworks, it proves that the space is evolving into a traditional financial sector.
But with strict borders.
The historic summer of 2026, driven by the Clarity Act and the election, provides the underlying bedrock. It gives investors the confidence to allocate capital strategically across the curve. You have high uptime transactional blue chips, like the $3.8 billion market cap of Litecoin. You have niche infrastructure utility plays like Jasmy. And you have your high beta volume trackers. The systemic risk being mitigated at the top, historically and mathematically, increases the baseline risk appetite at the bottom.
A regulated true USD stablecoin does not mathematically mitigate the risk of an unproven Web3 infrastructure token like React. It simply means the institution holding the stablecoin is legally safe.
But they share an ecosystem.
The core thesis that macroeconomic capital flows will saturate the entire ecosystem relies on a mechanism of wealth transfer that the Clarity Act is actively designed to restrict. We have to separate the undeniable maturation of Bitcoin from the highly speculative nature of the decentralized periphery. They are no longer the same asset class.
You see a divorce.
Regulation separates them. It does not unify them.
Well, so if I am summarizing your position correctly based on our discussion, you believe that while Bitcoin and top-tier compliant assets stand to gain tremendously from upcoming regulatory clarity, applying this bullish macro thesis to justify a broad DCA strategy into speculative microcaps is fundamentally flawed.
Exactly.
In your view, the Clarity Act is designed to build walls, not bridges, transforming assets like TUSD into massive institutional parking vehicles that will trap capital safely behind compliance mandates, essentially starving the lower end of the risk curve.
Precisely. Conflating the rigorous legal demands of federal legislation with the speculative momentum of a 40% bounce in an ERC20 token or a secondary wealth effect on Solana ignores the highly restrictive nature of how institutional money is legally permitted to operate.
And to summarize my stance, the operational reality of MicroStrategy's 3-2 Bitcoin sale, funding preferred stock dividends, proves that the digital asset space is transitioning into dynamic corporate finance. When you pair this maturation with the historic catalyst of late 2026, specifically the Clarity Act and the deregulatory push of the November election, we see a robust, evidence-based rationale for a structured DCA strategy. This strategy rightly spans from the impenetrable benchmark of Bitcoin through the cross-border utility of XRP and down into emerging Web3 infrastructure because institutional validation at the top invariably fuels innovation and liquidity at the bottom.
But despite our differing views on the destination of the capital, I think we both clearly agree on the mathematics of the triggering event. MicroStrategy's $2.5 million sale is entirely immaterial to the long-term thesis of Bitcoin as a global store of value.
Oh, 100%.
It was a headline that created retail noise, not a structural fracture in the asset's viability.
Absolutely. We are completely aligned there. The foundational strength of Bitcoin isn't in question, and there is little doubt that the second half of 2026, driven by these massive political and regulatory milestones, will be historically volatile and ultimately explosive for the broader digital asset space.
Which means the true value for anyone listening today lies in dissecting the mechanics of exactly where that explosive capital is legally permitted to flow. The market is maturing past the point of broad generalizations. We can no longer rely on the assumption of a rising tide.
Right, it's getting specialized.
The future belongs to those who understand the specific, coded filtration mechanisms of this new financial architecture.
It brings us right back to our opening thought. The capital is indeed coming. The momentum is building. The question you have to answer for yourself is whether that momentum will flood the entire ecosystem, lifting every speculative token and infrastructure play along the way, or if the new regulatory landscape has built a system of rigid tracks designed to capture that power before it ever reaches the periphery.
A lot to think about.
There is clearly much more to explore here, especially regarding how global data compliance laws will mechanically drive value into real-world utilities like JAWSME. But for now, we leave it to you to decide how far down the risk curve you are willing to venture.